Casual Corner. I'm Angela Bruce Heath. I'm here with Keyshawn Wilson, and we're going to be answering some frequently asked questions about life insurance. So, Keyshawn, thank you for joining me today. So, tell me, what exactly is life insurance? Because some people get it mixed up with disability, believe it or not. So, can you explain exactly what is life insurance?
Absolutely. So, life insurance, simply put, is protection upon death. So what you're doing is, if you know what insurance is, you're transferring the financial risk and costs associated with the disaster of death over to the insurance company. So the insurance company then foots the bill of those things and pays for whatever you wanted to protect financially in your life insurance plan. So if we talk about term insurance, you're looking at immediate protection needs or immediate financial needs like income replacement. If we're talking about permanent insurance, which would be the whole of life insurance, that is more of a creation-based tool as opposed to a protection-based tool. But you're basically transferring the cost of whatever goal you want to have or protect over to the insurance company at the premium that you pay for the product.
Okay. So, some people say if they have life insurance, it can't benefit them. So, but I also hear that whole life can be a benefit or has a benefit for people while they're still alive. Does term do the same thing? Or explain the difference between term and permanent.
Absolutely. So the first thing that I like to say to people about life insurance is when we sign up, you need to know that this is not something we're purchasing for you. So the benefits that are for you within the plan should be the last thing that you are worried about. So for example, with term insurance, if we do immediate protection needs, there's nothing in it for you. You're protecting the value that you are creating while you are alive to stay valuable upon your death. When it comes to the whole of life, yes, there is cash values that you can have access to in your time, in your lifetime. Is it considered something that I would say profitable to you versus what you put into the plan? No, not at all. Could it be a safety net? Absolutely. The bulk of what you're purchasing in these plans are for someone else upon your death. They are essentially death plans. Planning for that stage in life the best way possible.
Okay. And in regards to, let's talk about the term a bit.
Yeah.
So, in regards to term life, can people determine what does term mean, first of all?
Yeah.
And can people determine what that, how much life insurance they want or length of time for that life insurance?
Yes, good question. So it means exactly that. Term is the time frame that you want to have the insurance for. So one of my favorite examples to give is we look at something like a mortgage, for example. A mortgage is a temporary financial obligation to the bank when you purchase a house. If we think of 25 years, 30 years of mortgage payments, that's a temporary need.
Okay.
So we will set up a plan that temporarily fixes the need if the rush were to happen while it is a need. And then if you have a 25-year term on a 25-year mortgage, after 25 years, yes, your term will end, but your mortgage payments and obligations will also end. So you had protection for something that could have proved financially catastrophic to whoever you left it to if they wasn't in a position to pay for it. Or if you outlived the plan and outlived paying your mortgage, you now have the house in the form of an asset and not a liability to the bank because you owe them money.
Okay. Follow up to that question. So, what you're really saying is that if, let's say, I have a mortgage, say a 20-year mortgage. So basically, I would get a 20-year term. Would it work like that?
20-year mortgage, yes, 20-year
like
term.
a 20-year term.
Yeah.
And then if I pass away, say 15 years from now, then do my whoever I leave it to, do they get it 15 years? Well, when I die, or do they have to wait for the extra 5 years?
It's a good question. It's immediately. It's
Immediately.
So if you have we'll use 20 as the example since you mentioned it.
Okay.
If you have a 20-year mortgage and your value is $1 million, for an example, ideally we'd be looking at taking out a term insurance plan for that time and amount. We want to protect the $1 million for the 20 years that it needs protection. And you mentioned the 15-year period, and why I think term is beautiful is because the $1 million benefit you have remains $1 million. even as you start to pay off the mortgage payment. So if something were to happen, you're 15 out of the 20 years, you've paid 75% of the mortgage value. Your protection plan is still 100% of what it is you protected.
Okay.
So you can then not only pay the mortgage off if the last 25% left, the other 75% is still being pocketed by your beneficiary. So they then have some cash on top of the home that you then purchase for them to provide a cushion financially
Oh, I see.
as
Okay.
well.
Okay.
But you will get the funds immediately. I mean, all that's really needed is proof of death
Okay.
and that you are the person who's supposed to be receiving the benefits. And it's just a matter of getting what's due to you over to you.
Okay. So still in the term of the mortgage, because people, most people, a lot of people take out a mortgage. So when you say, so if the mortgage is not paid, the person passes away, does the bank get does the bank get part of the insurance, or does it go all to the beneficiary? Where does the bank fall into this?
So that's a good question, because not all banks make it mandatory for you to assign rights to the policy over to them. So what usually happens when the bank has interest in the value, if you owe them money, they'll give someone and say, hey, look, we need to see something that gives us some sort of protection for this value if the rush were to happen to you. So we have policy assignments. If a bank is assigned rights to a policy and a person passes away, the bank has first dibs on what it is that, whatever value is there, and they'll be able to claim whatever portion is owed to them based on the outstanding mortgage balance. The rest would then go to the family. If the bank has said, hey, we do not need you to assign rights to this mortgage balance, it's up to the beneficiary, because the beneficiary is going to receive the benefits. I mean, if they want the house, they're going to have to pay the bank off and do what they have to do. But you're right, they can say, hey, I don't want to pay the house off, and I don't want to, if the bank hasn't asked for these rights to be assigned. So it's on the beneficiary if not assigned. If assigned, the bank can come in and say, hey, this is what belongs to me. I want to collect that and, pay off the debts that we had with the deceased.
Thank you so much, Keyshawn. I've learned a lot about the importance of insurance. I'm sure our audience has as well. So thank you. Thank you so much for joining us on the Casual Corner, and we'll see you next time.